Welcome to this tutorial on Exponential Moving Averages, or EMAs, as they're commonly known in trading. Today, we'll explore what EMAs are, how to use them, and what they signify in chart analysis. First, let's define what an EMA is. An EMA is a type of moving average used in technical analysis to smooth out price data, giving more weight to the most recent prices. It helps you visualize the trend of a cryptocurrency's price over time, offering a clearer picture of where the market might be headed. Why are EMAs important? Traders rely on EMAs to identify trends more easily. When the price is above the EMA, it often indicates an upward trend. Conversely, when the price is below the EMA, it may suggest a downward trend. The 50 EMA is particularly popular among both retail and institutional traders, such as banks and hedge funds, making it a critical tool for trend identification and decision-making in trades. In addition to the 50 EMA, we also have other key EMAs like the 5, 13, 50, 100, 200, and 800 EMAs. While using a single EMA can give you a basic sense of the trend, combining multiple EMAs can provide a more comprehensive view, enabling better trading decisions. 5 EMA and 13 EMA are highly responsive to recent price changes, making them ideal for spotting short-term trends. Day traders and scalpers often use these EMAs to react quickly to market movements. 50 EMA and 100 EMA are less sensitive to daily price fluctuations and are typically used to gauge medium-term trends, making them suitable for medium-term trades. 200 EMA and 800 EMA are considered long-term indicators. Crossover strategies. Traders often look for crossovers between shorter and longer EMAs as potential signals for entering or exiting trades. For example, when the 50 EMA crosses above the 200 EMA, it forms a golden cross, which may signal a strong bullish trend. Conversely, when the 50 EMA crosses below the 200 EMA, known as a death cross, it might indicate a bearish trend. Think of EMAs like a rubber band that stretches around the price of a cryptocurrency. When the price moves quickly in one direction, the EMA stretches and tries to keep up. However, just like a real rubber band, the EMA doesn't move as fast because it averages out the movement. If the price moves too far away from the EMA, it creates tension, similar to when you stretch a rubber band too much. This tension often results in a snap-back effect, where the price may pull back towards the EMA. Traders use this concept to anticipate reversals or pullbacks. If the price gets too far from the EMA, it might soon correct itself, moving closer to the EMA. To sum it up, EMAs are powerful tools that help you identify trends by smoothing out price data and reacting quickly to recent changes. By using multiple EMAs, such as the 50, 100, 200, and 800, you can get a clearer picture of both short-term and long-term market trends, allowing you to make more informed trading decisions. Watch for EMA crossovers as potential signals for trend reversals or confirmations and use them to time your trades more effectively. Remember, EMAs are like a rubber band, stretching and snapping back with price movements. So keep an eye on how far the price deviates from your EMAs to spot potential trading opportunities.